You've probably seen headlines around Trump accounts and a free $1,000 for your kids. Today, we want to talk about what exactly Trump accounts are and how they may benefit you and your family, how they may or may not as well. Today, I'm joined by Nathan Stone, Associate Advisor at Delta Wealth. Nathan, first, can we start off in plain English? What is a Trump account?
Yeah, absolutely, Nico. So a Trump account is basically just a tax advantage savings account for your children. It acts very similar to a traditional IRA just for your children. It's available for anybody under the age of 18 who is a US citizen in America. So there's a couple different rules pertaining to these accounts. It's fairly simple, but there's a contribution limit of about $5,000 per year per child. So no matter how many children you have, $5,000 per seat per child. So there's also some other contribution rules that are interesting for this account. Specifically, there's an employer contribution that's actually tax deductible from the employer of $2,500 to each employee. So only $2,500 per employee is eligible for that. So that's going to have to get split up between the children if you have multiple children there. So that's a weird little nuance regarded with those. So something important also with this contributions is they are non-deductible for the parent. So if you're just putting in your after-tax dollars into your children's Trump accounts, those are going to be non-deductible after-tax dollars. The good thing about that is when your child actually turns 18 and that converts to a traditional IRA, those contributions are going to end up being after tax. Therefore, you're not going to be taxed when you convert those or take it out of that account in the future for those children.
When you do that conversion, Nathan, is there any sort of, say at age 18, we've kind of heard about people talking about converting them into Roth IRAs. Is there a taxable event there at all, or what would that look like theoretically?
Yeah, absolutely. So there's actually some interesting timing that you want to be very attentive to when you're converting from a Trump account to a traditional IRA, then to a Roth IRA. So when you're converting these accounts, you actually need to, think about it like it's a pre-tax, your 401k. If you want to then pull that over into a post-tax account, you're going to have to take the funds that you're converting out, and that's going to act as ordinary income. You're going to receive that income and then put it into this post-tax vehicle. Now, there's a couple reasons why this is super powerful and a great planning tool for anybody who has a Trump account, and that's because of the time horizon for these children. If you convert, let's just call it $50,000 from a Trump account when your child's 18 into a Roth, yeah, your child's going to pay taxes on that 50,000. So let's say, they end up paying 10%, so that's $5,000. Then that 45 grand has the rest of their life until retirement to grow tax-free. So when they get to 60, 65, and they want to start drawing down from this Roth IRA, they have to pay zero taxes. So that's what's really powerful about this.
Quick question. So if somebody puts in that scenario where they're converting $50,000, if they originally put in $10,000, is that original $10,000 in contribution also taxable? Or is it just the growth of 40,000? How does that work?
Great point. So no, the original contribution. So let's say you put in 10 grand, like you just said, that is going to be non-taxable because you contributed after-tax dollars into the account.
Okay.
Again, to bring up the caveat that I brought up earlier with employer contributions, those are tax deductible from the employer. So those are actually going to be taxable when you take it out. So let's say you never contributed as a parent to the account, but your employer did every year. That whole balance then would be taxable.
Okay. Yeah. And I've seen that before where people kind of been talking about, actually on the one of the Trump account websites, they talk about if the employer puts in $2,500 for each year of the first 18 years at an 8% growth, you're looking at ballpark around $90,000. So it could be a large tax bill, but the other side is, a lot of our viewers are entrepreneurs. And so it's like, well, the business is writing it off. And then one day, maybe the kid is paying, in theory, they're paying at a lower tax bracket. So the whole family's taxes are a little bit lower. That's one thing to keep in mind. Another question I have for you is you had talked earlier about putting $5,000 per year and going for a child. A lot of people are used to 529s. And in a 529, you can put in some money into your kid's 529 and the grandparents can as well. This is a bit different though, right? In that there's a cap of 5,000 no matter who's making the contribution. Can you kind of talk about that a little bit?
Yeah, absolutely. Great to contrast this against a 529 because that's another great option when you're talking about planning for your children. But to your point, yeah, you just have a $5,000 cap. So whether your grandparents put in $4,000, that leaves you're only able to put $1,000 as a parent or however else you want to cut it. But again, that's per child. So assuming you have multiple children, then yeah, 5,000 per child is the max you could do. Whereas with a 529, that cap's not quite there.
Okay. And I know you've done some research on this. You've actually really headed it up for the whole firm. You found a scenario where there's a clear cut, no question, it makes sense to have a Trump account. Can you kind of walk us through what that scenario is?
Well, truly, it's the buzzword that everyone's been hearing. This free $1,000 that they're giving to any child born 2025 through 2028. That's an absolute no-brainer. There's no reason not to take the government up on that. All it takes is a check mark on your tax return and your kid's social security number. And we can kind of walk through the setup for that, but it's very, very simple to get these set up. And there's no reason you shouldn't sign up and claim your free $1,000. And what's cool on top of that is they're trying to give back to the families as well in the lower medium income neighborhoods. So if your zip code has an average household income under $150,000, you're actually going to end up getting a bonus $250 on top of that $1,000. So $1,250 is going to go to your child's Trump account right when they're born, and that money is going to grow very, very steadily, not quickly at first, but compounding over time, and all the way up until retirement. Those accounts are going to be worth some real money.
Okay. All right. Sounds good. And then if we start to kind of compare and contrast this, say, a Trump account versus a 529 versus a custodial, a UTMA, a Roth IRA, a traditional IRA, can you talk about what the advantages would be on each one versus one another? And, this idea, we start with a pot of money and we're growing to these goals. Like, when is it correctly aligned? Where should you be using a Trump account? Where should you not, as we compare and contrast?
Yeah, so each family has different goals for their children. Some want to set them up, for their lives through investment accounts. That's going to be your UTMA. Granted, there's some negative tax consequences such as kiddie tax. We can talk about a bit later. You have your custodial Roth IRA, which is what we talked about with that post-tax money growing and end up being tax-free in retirement. That's a great option. But the caveat there is your child needs earned income. Trump account, as I don't know if we mentioned yet, your child does not need any earned income to contribute to this account. It's the only retirement account that a child can have that you don't need earned income to contribute to. So that's the clear win for the Trump account there. 529, however, same situation. It's not a retirement account, but you do not need any earned income to contribute to this as a child. Anyone can contribute to it. And this is the clear-cut winner for your education expenses. Depending on your state, there's also tax credits that you can receive. Very, very clear wins that you can do there if you're planning on funding your child's education. Again, with the 529 plan, another really, really cool thing about them is there is a backdoor exit for these plans. There's actually two of them. Let's say your kid either gets a full scholarship, then what do I do with all this money that I have for the kid? You can either change the beneficiary so the money ends up going to either the next kid down the line or grandchildren, or there's this also new with Secure Act 2.0, $35,000 rollover to your Roth IRA, that same account that we talked about earlier, which is a great option to get these kids set up for their retirement at a young age that will just grow indefinitely. Yeah, then backing into the Trump account, again, it's very similar to a standard IRA. You can just get some deferred income for your child and set them up there as well.
And I think one thing that we've been seeing some people talk about is limited amount of investment choices with the Trump account. And with what you just highlighted there, just being very clear on, look, here's where each account is best for it. I don't think that those investment choices should override the validity of a Trump account, especially like you were saying, when it's a free $1,000, right? Like, it's a no-brainer then. That's when you want to do it. Sometimes people can kind of overthink these things. So us being very specific and saying, all right, if our end goal is this, then this is the correct account that's assigned with that. Yes, we got to work within the constrictions that we have. Like you were talking about with 529s, like you typically have that menu at the state, right? You got to choose between those. That doesn't mean that we're then excluding 529s because we can't invest in anything we want to invest in. So really just looking at this idea we talk about all the time, which is returns are expected, taxes are guaranteed. So let's be really smart about what is guaranteed, and that's taxes, right? I mean, choosing the right account.
Absolutely. I mean, something that we harp about all the time here at Delta is finances is much more personal than anything else. And every family's life is a bit different. Whether you want to plan on your children going to college, or you're like, they might not go to college. I want to set them up in a different way for retirement or just for any expenses. There's different approaches to these, and it's going to require different investment styles. So whether it's, first funding the 529 and then moving down to the custodial Roth IRA, then the Trump account, or if you're going to start with the custodial Roth IRA, then put in a little bit of the taxable UTMA account for your child. Every family's different, and it's really important to kind of weigh these options and see what's best for your family situation with taxes in mind, especially.
Yeah, no, absolutely. Nathan, thank you for all the research you've done on Trump accounts and joining us today. Kind of any final concluding thoughts as we talk about Trump accounts and in general savings for children?
I think it's super important to get out there and talk to somebody about this. Do your own research, learn about all the different options that you have with these different accounts, because there's a lot of them and everybody's situation is different. And I think it's super important, am I focused on education? Do I want to fund this? Or, am I want to go a different direction and set them up for their rainy day fund with these? Because that's what these Roth IRAs are at the end of the day, is if you need money, you can pull it out. Granted, are there penalties? Sure. But if you need money, push comes to shove, you can get it out of those accounts. That's giving your child a safety net. And each dollar works different. Each family works different. Using the right combination of these different accounts is super important. And set a plan. Let's put this money to work and set yourself up and your children and your family for success.
And all I'd add to that too, Nathan, is you kind of talked about how there's different tax benefits to each of the plans. So if you know which one of those savings plans is best aligned, whether that's the 529, the Trump accounts, you know where you're going at the end. Then you also look at that tax component too, and you say, okay, and I'm getting this tax kicker. It makes even more sense. You really can allow those benefits to compound over time. Again, thank you, Nathan, for joining us today. For anybody who has any questions about what they may have seen, please feel free to reach out. In addition, please feel free to watch some of our additional videos on the playlist outlined below, whether that's on taxes or investments. Thank you. Cheers. Bye-bye.